So a popular question investors often ask is whether now is a good time to invest. It gets asked when markets have been going up and all-time highs are being reached because there's a concern that something just can't go up forever. It gets asked when news about market or economic or geopolitical circumstances turn negative. Of course, you can find negative news all the time. The current environment seems a little bit more like the second than the first. Just look at this list, which you can probably add to with just a little news watching or reading. But there's trouble everywhere, and markets have been responding to all this bad news for most of 2022. Most stock indexes have fallen over 20% by the end of June, and bonds, with the Fed aggressively raising interest rates to fight inflation, those bond markets had fallen by over 10%. That was actually the worst performance over a 6-month period for U.S. bonds on record. And while there were glimmers of hope in July, it's not as if any of the issues on the previous list have been resolved with any finality or certainty. Indeed, you don't have to look any further than Wall Street analysts like those at Goldman Sachs to find warnings that the market downturn may not be over yet. But with all the well-publicized troubles, is there perhaps a silver lining in it all for investors? What if all this bad news and subsequent market responses has actually produced an environment where future expected returns for stocks and bonds are now higher than they were just 12 months ago? Could it be that today is actually a better time to invest because of higher expected returns in the future? Why would now be a time of higher expected returns than 12 months ago? Well, this graph from Vanguard shows how the majority of an investor's return from bonds is derived from the income paid by the bond, the interest rate. The higher the interest rate of the bond, the greater the income return. Investors buying bonds today are expecting, with good reasons, returns more than 2 times higher than they would have expected just 12 months ago. With today's higher yields, expected returns for bonds have risen substantially. And are there reason to think that stocks now have higher expected returns than just 12 months ago? The price to book ratio is used as one indicator for how expensive or inexpensive stocks are trading at. Valuations today versus 12 months ago are significantly lower. So stock investors today are buying companies on sale relative to prices 1 year ago. All things being equal, paying a lower price for an entire stock market has the effect of raising future expected returns over a longer period. You can see how some of the largest research firms are adjusting their long-term expectations for where they were even 6 months ago. Again, citing a recent publication by Vanguard, this graphic shows how they've adjusted their 10-year stock and bond outlook, raising their ranges of expected returns by 1% or more per year for stocks and 1.5% or more per year for bonds. Here's another way to look at the future expected returns. Do you expect the markets to recover? And then how quickly do you expect them to recover? Given the drawdowns, and a drawdown is just a measure from the peak of the market to the last low point. Given the drawdowns of these markets over the last 6 to 10 months, if they were to get back to break even in 12 months, you can see the return required in the 1-year column. Those are pretty big numbers. Even if it took 3 years to get back to break even, which seems reasonable, maybe even a little pessimistic, the returns to investors for those 3 years would be at or above historical averages. Again, higher expected returns. So back to the question, is now a good time to invest? If the answer in the fall of 2021 was yes, then yes seems like an even more reasonable answer today, even with very visible global uncertainties in the news. But maybe the best answer to the question, is now a good time to invest, is simply to look at market history. While market highs don't occur every month, the long-term history of markets has been to provide positive return to relatively patient investors. Looking at history, the expectation of investors should be a future that includes new market highs. Why? Well, profit motivations for investors and entrepreneurs and larger companies have all aligned in the past, and they still align today to spur innovation, technology, productivity, and providing solutions to problems that people are willing to pay for. Positive expected returns are an important part of progress. Now, as always, our advice to investors is to construct a portfolio based on a well-thought-out financial plan that balances priorities, including having timely access to cash when needed, long-term inflation-beating growth, usually provided by a globally diversified stock portfolio, and managing overall volatility, often with bonds. It is very hard to imagine a wrong time to invest in a plan-based portfolio designed for all the time horizons and goals of an investor. You know, the uncomfortable truth for all of us as investors is that some uncertainty is always present. Sometimes the risks just seem more noticeable, maybe like today. Historically, the biggest risks, though, have turned out to be the ones no one saw coming. The most recent global example, of course, being COVID, but the Russia-Ukraine war was another example earlier this year. One way to become more comfortable with uncertainty is to understand the past in ways that help form a reasonable view of the future, not necessarily seeking predictions, but seeing the high probability of markets providing positive returns to patient investors. It's especially helpful right now to see how the current environment may also have created higher expected returns than just 12 months ago. As always, thanks for watching, and we hope to see you in a couple of weeks.